You could describe 2025 as the year the markets played a constant game of financial chicken. Every few weeks, the story changed. One moment, recession warnings were everywhere. The next, markets were ripping higher like nothing was wrong. Bears were calling for a crash. Bulls were buying AI stocks like it was the last chance they'd ever get. And somehow, both sides sounded reasonable. Unemployment stayed relatively low. Consumers kept spending. Stock prices kept climbing. But beneath the surface, something didn't feel right. Valuations were stretched. Market leadership was narrowing. Debt levels were rising, and nobody could agree on what came next. Now we've stepped into 2026. And instead of clarity, things feel even more chaotic. Interest rates might come down further. AI could justify its height or fall short. Markets could surge higher. Or we could look back and think we should have just bought treasuries and logged off. So instead of pretending there's one clear answer, let's talk about the three realistic paths markets could take this year. The bearish case, the bullish case, and the uncomfortable middle ground that almost nobody is positioned for. Because history shows it's usually the ignored scenario that causes the most damage. Let's start with the bear case. Not because disaster is guaranteed, but because ignoring risk is how investors get blindsided. At the center of nearly every market conversation right now is artificial intelligence. AI might absolutely transform parts of the global economy over the next decade. But markets don't price decades. They price expectations. And sometimes, those expectations get pulled forward too aggressively. Many of the most popular AI-linked stocks are trading at valuation levels that assume near-perfect execution, not good execution, perfect execution. That's not investing. That's pre-ordering the future and hoping nothing goes wrong. And the problem isn't limited to individual stocks. It's what those stocks are doing to the broader market. The S&P 500 looks diversified on paper. 500 companies, multiple sectors, different business models. But in reality, a small group of mega-cap technology companies now account for a disproportionate share of the index's total value and recent gains. When those companies rise, the market looks healthy. When they stall, the entire index feels it. This creates a fragile structure, not because these companies are bad businesses, but because concentration amplifies downside risk. A pullback in a handful of stocks doesn't stay isolated. It bleeds into index funds, retirement accounts, and passive portfolios that millions of investors rely on for diversification. And history tells us that periods of extreme concentration don't last forever. That doesn't mean a crash is imminent. It means expectations are doing a lot of heavy lifting. There's another part of the bear case that doesn't get enough attention. Markets move in cycles. Corrections aren't anomalies, they're normal. Over long periods, U.S. equities experience regular pullbacks of 10% or more. Sometimes those corrections happen quickly. Sometimes they happen slowly and unevenly. After multiple years of strong returns, the odds of a cooling period naturally increase. That doesn't require panic. It doesn't require a recession. Sometimes it's just gravity doing its job. But here's where many bearish investors get it wrong. Being early feels exactly the same as being wrong. Markets can stay elevated longer than logic alone would suggest, especially when liquidity is still available and narratives remain intact. So even if the bear case is directionally correct, timing it is another matter entirely. Which brings us to the bull case. Because what if markets don't care about historical averages? What if valuations stay elevated? What if risk assets continue to grind higher? The strongest argument for the bull case is monetary policy. Interest rates don't need to collapse to matter. They just need to stop rising. Lower or stable rates reduce pressure on valuations. They make future earnings more valuable today, and they tend to loosen financial conditions overall. That's why markets can move higher, even when economic data feels mixed or confusing. Liquidity matters. Another factor supporting the bull case is fiscal policy. Government spending remains elevated by historical standards. Large deficits aren't ideal in the long run, but in the short term, they inject money directly into the system. They support demand. They support corporate revenues, they delay economic slowdowns. And unlike monetary policy, fiscal policy changes slowly. Programs don't disappear overnight. Budgets don't shrink instantly. So even if growth cools, the spending backdrop can remain supportive longer than many expect. Then there's psychology. As long as markets avoid sharp declines, confidence rebuilds quickly. Cash on the sidelines gets redeployed. Dip buyers reappear. Risk tolerance creeps higher. This creates an environment where markets can keep moving up. Not explosively, not euphorically, but steadily enough to frustrate anyone waiting for the perfect entry. That's the bull case, not a melt-up. Just enough support to keep prices elevated. But this is where things get uncomfortable, because there's a third outcome almost nobody prepares for. Not a crash, not a rally, a long, choppy sideways market. The kind of market where rallies stall just as confidence rises. Where pullbacks feel scary but never turn into real opportunities, where leadership constantly rotates and nothing trends cleanly. These markets are mentally exhausting. Every decision feels wrong in hindsight. patience gets tested. And this is where investors quietly do the most damage to their own portfolios. They overtrade. They chase short-term narratives. They abandon long-term plans out of frustration. Sideways markets don't destroy wealth in dramatic crashes. They do it slowly through poor timing and emotional decisions. And historically, these periods show up more often than people expect, especially after long runs in one direction. That's why pretending to know exactly what 2026 will bring is dangerous. Markets don't reward certainty. They reward preparation. So what do you do instead of trying to predict headlines? You focus on resilience. That means diversification that actually diversifies, not just different tickers tied to the same theme. It means understanding your risk exposure, not just your return potential. It means recognizing that sometimes doing nothing is an active decision. And most importantly, it means accepting that uncertainty isn't a flaw in the system. It is the system. The investors who survive long-term aren't the ones who predict every turn. They're the ones who avoid being forced into decisions at the worst possible time. 2026 doesn't need to be dramatic to be dangerous. It just needs to be confusing. And confusing markets punish impatience far more than ignorance. If you want clear, grounded breakdowns of markets, money, and investor psychology without hype, subscribe to this channel, because the goal isn't to predict the future, it's to stay rational while everyone else loses their footing.